To start off, I will give just a quick overview on the background of the LIBOR transition and then jump into the substance here. So the London Interbank Offered Rate, or LIBOR, is likely to be discontinued after 2021, posing some important questions. What is happening? What are regulators saying? How will this affect my company's existing LIBOR-based contracts, such as floating rate notes or preferred stock? How will this affect my company's SEC reporting obligations? What will replace LIBOR, and how should my company approach its future contracts that have a floating rate component? Adding urgency to this, on July 12, 2019, the SEC Divisions of Corporate Finance, Investment Management, Trading and Markets, and the Office of Chief Accountant published a joint statement encouraging market participants to proactively manage their transition away from LIBOR, which I'll call the SEC statement. In this presentation, I'm going to touch on all of these topics as well as the SEC statement. So, what is happening? LIBOR is an indicative measure of the average interest rate at which major global banks could borrow money from one another. It is quoted in multiple currencies and on multiple time frames using data reported by private sector banks. For many, many years, LIBOR has been the standard base rate used by companies when they borrow money using a floating rate. The UK Financial Conduct Authority, which regulates LIBOR, has announced that it will no longer persuade or require banks to submit rates for LIBOR after 2021. In light of this, it's expected that a number of private sector banks currently reporting information used to set LIBOR will stop doing so after 2021 when their current reporting commitment ends. This could either cause LIBOR to stop publication immediately or cause LIBOR's regulator to determine that its quality has degraded to the degree that it is no longer representative of its underlying market. Sorry, I'm just letting the slides catch up. So, what are regulators saying? On the screen now, you have a number of quotes from regulators like the SEC and the Federal Reserve, or officials of those entities. The overall message from regulators is that companies should start acting now to analyze and address or mitigate their LIBOR risk. One quotation just yesterday from John C. Williams, the President and Chief Executive Officer of the New York Fed, which hasn't been included on this slide, sums up the regulator's attitude pretty well. If your firm is one of those hoping that the problem will go away or feeling nostalgic and counting on an extension to the deadline, take this message back. The clock is ticking, LIBOR's days are numbered, and we all need to plan our part in preparing the industry for January 1, 2022. Now I'll talk a little bit about the impact on existing contracts referencing LIBOR. Because there's a substantial likelihood that LIBOR will discontinue after 2021, a company's existing contracts that extend beyond that date and have payment terms that are linked to LIBOR may create legal risk. Many legacy contracts have interest rate provisions referencing LIBOR that, when they were drafted, did not set forth terms governing a situation where LIBOR is permanently discontinued. As a result, there may be uncertainty or disagreement over how the contract should be interpreted. In addition, although some contracts may clearly state what should happen if LIBOR is not available, the mechanism provided may be inconsistent with the expectations of affected parties. This is often the case where parties included a contractual provision, assuming that the provision would be used only if LIBOR were temporarily unavailable, not in a context where LIBOR has been permanently discontinued. For example, many floating rate notes that have been issued by companies provide that if LIBOR is not available when interest is supposed to reset, the same value for LIBOR will apply in the next interest period. This type of provision might work well where in a situation where LIBOR is temporarily unavailable, but if LIBOR is discontinued permanently, that will have the effect of converting a floating rate note into a fixed rate note, which is hardly what parties expected when they entered into the contract. The SEC staff has encouraged market participants who have not already done so to begin the process of identifying existing contracts that extend past 2021 to determine their exposure to LIBOR. For an SEC reporting company, If the company's contractual LIBOR exposure is material, then the company is likely to have disclosure obligations under the SEC's rules. In the SEC statement, the SEC staff notes that a number of existing rules or regulations may require disclosure related to the expected discontinuation of LIBOR, including those related to risk factors. Item 105 of Regulation SK and Item 3D of Form 20F require companies to disclose the most significant factors that make an investment in the company speculative or risky, and in making those disclosures to avoid boilerplate disclosure and instead provide disclosures that are tailored to the company's facts and circumstances. How might a company's plans and efforts to transition away from LIBOR affect its underlying results or financial condition in the near future? Management's discussion and analysis. Item 303 of Regulation SK and Item 5 of Form 20F require companies to identify, among other items, known trends or known demands, commitments, events, or uncertainties that will result or that are reasonably likely to result in a material increase or decrease in liquidity, and to describe any known trends or uncertainties that have had or that a company reasonably expects may have a material favorable or unfavorable impact on income. Again, a company's plans and potential mitigation efforts for LIBOR may need to be discussed in this context. Board risk oversight. Item 407H of Regulation SK requires companies to disclose the extent of the board's role in risk oversight of the company, such as how the board administers its oversight function and the effect this has on the board's leadership structure. And finally, financial statements. In the release, the SEC Office of Chief Accountant states that risks related to the expected discontinuation of LIBOR and mitigating actions taken in response may have broad impact on a company's financial statements. According to the Chief Accountant, these issues could span a number of different areas, including, for example, the accounting and financial reporting for modifications of terms within debt instruments, hedging activities, inputs used in valuation models, and potential income tax consequences. In particular, the staff of the Division of Corporation Finance also notes that companies should consider disclosing the status of company efforts to date and the significant matters yet to be addressed. This, in general, would be qualitative disclosure explaining what your company has been doing to prepare for the transition and what remains to be done. When a company has identified, or the company should also consider disclosing when they have identified a material exposure to LIBOR but do not yet know or cannot yet reasonably estimate the estimated impact. And finally, companies should consider sharing information used by management and the board in assessing and monitoring how transitioning from LIBOR to an alternative reference rate may affect the company. Now I'm going to shift gears a little bit and discuss some considerations in connection with new floating rate notes and preferred stock with a floating rate. Market participants should consider whether new floating rate notes or preferred stock that they issue should include more effective LIBOR fallback provisions, or whether those instruments should reference a different base rate entirely. Fallback provisions are contractual terms addressing how interest rates should be determined if LIBOR is not available or is discontinued. In the U.S., the Alternative Reference Rate Committee, a group convened by the Federal Reserve Board, has identified the secured overnight financing rate as its preferred alternative rate for U.S. dollar LIBOR. I'll discuss SOFR in a bit more detail in a moment. The ARC has also published recommended fallback language for new issuances of floating rate notes, as well as other products such as syndicated loans, bilateral business loans, and securitizations. In general, these fallback provisions are triggered by a clearly discernible external event, such as a public statement by the administrator of LIBOR that the administrator has ceased or will cease to provide LIBOR. Once a triggering event occurs, the fallback provisions provide for a waterfall of 5 alternative rates that may apply in place of LIBOR. The first alternative rate that can be determined going down the list then replaces LIBOR. The first alternative rate in the waterfall is term SOFR, followed by compounded SOFR. I will discuss these rates in more detail later on. The next 3 alternatives include the alternative rate selected by the Board of Governors of the Federal Reserve, and this is in a context where term SOFR and compounded SOFR are not available, followed by the fallback rate that is included in ISDA standard definition for the then applicable fallback, and if all else fails, the rate selected by the issuer or its designee after giving due consideration to any industry-accepted rate of interest as a replacement for the then current benchmark. The ARC fallback provisions also provide for an adjustment or spread to be added to the alternative rate selected in accordance with the provisions in order to make the new rate more comparable to LIBOR. This spread will be recommended by the Federal Reserve, but it has not been determined yet. Finally, ARC's fallback provisions provide that, in connection with implementing the new alternative rate, the issuer of the securities will have the right to make certain changes to the terms of the notes, as may be appropriate to reflect the adoption of such alternative rate in a manner that's consistent with accepted market practice. When issuers are drafting disclosure relating to the terms of the notes, they should consider carefully the risk factors or other language when they're describing the rights that the issuers have to make these changes, as well as the potential for the fact that the initial base rate for the notes may be replaced by a benchmark replacement if the initial base rate is discontinued. So far in the market, we've seen a number of issuers continue to use LIBOR, often including the ARC recommended fallbacks in their notes. However, we've also seen SOFR making headway. In recent months, a number of issuers have issued floating rate notes and preferred stock that are linked both to term SOFR and compounded SOFR. Switching gears now to talk about SOFR, the ARC's preferred replacement for LIBOR. SOFR is administered by the Federal Reserve Bank of New York, and it's a broad measure of the cost of borrowing cash overnight collateralized by Treasury securities, that is, Treasury repo transactions. SOFR is a secured rate, and it does not incorporate any element of bank credit risk, unlike U.S. dollar LIBOR. SOFR is an overnight rate, whereas U.S. dollar LIBOR is a forward-looking term rate that represents interbank funding for a specified term. So, how can SOFR be used as a benchmark for issuances of floating rate notes? There are three main options we have seen used in the market: term SOFR, compounded average of overnight SOFR calculated in arrears, and a simple average of overnight SOFR calculated in arrears. I will discuss each one of these options at a high level. Currently, no forward-looking term SOFR rate exists. The ARC has set a goal of seeing forward-looking term SOFR rates based on SOFR futures and swaps produced, but these rates may not become available until 2021, close to when LIBOR is expected to cease. Given the potential delay before term SOFR becomes available, the ARC has emphasized that market participants should not wait for the term rate to arrive before adopting SOFR. Even though term SOFR does not yet exist, however, some issuers have already begun issuing fixed to floating rate notes and preferred stock linked to term SOFR. The interest or dividend rate on these instruments is fixed until some future date, often 5 or more years in the future, at which point the rate becomes a floating rate. Issuers of these instruments appear to be assuming that term SOFR will likely become available before the floating rate period begins. The rate fallback provisions for these instruments mirror the ARC's recommended fallback provisions for U.S. dollar LIBOR instruments, with the rate waterfall adjusted to reflect the fact that term SOFR is the initial stated base rate, rather than the first fallback option to U.S. dollar LIBOR. Thus, even if term SOFR has not become available by the time the floating rate period begins for these instruments, issuers and holders of the instruments will be in essentially the same position as they would be if the initial interest rate had been U.S. dollar LIBOR using the ARC's recommended fallback provisions. Since many details of term SOFR are not known, for example, who the administrator will be that publishes term SOFR and its publication schedule, the terms of these securities provide that the issuer will have the right to implement a number of changes to the terms of the notes once details relating to an officially endorsed term SOFR become available. For example, issuers may be able to change the definitions of interest period, interest reset period, and interest reset dates, as well as the timing and frequency of determining term SOFR under the notes. When using term SOFR, issuers should carefully consider their disclosures, including risk factors relating to the fact that term SOFR doesn't exist yet and that the issuer has the right to make these changes to the terms of the notes, among other issues. And all of the issuers that we've seen in the market using term SOFR have included risk factors along these lines. The other way to use SOFR is to use an average of the overnight rates. As an overnight rate, SOFR can be somewhat volatile, So in order to address this, the market participants generally use an average of daily overnight rates over the course of the relevant interest period in order to smooth out potential volatility. The terms of preferred stock and notes with payments based on such an average SOFR rate generally have provided that the average is calculated in arrears at or near the end of the interest period. This means that the average rate will reflect what actually happens to SOFR over the interest period. On the other hand, this practice provides very little notice before the payment is due. In general, we have seen two conventions for determining this average of daily overnight rates adopted in the marketplace. The first is simple interest. Under this approach, the additional amount of interest owed for each day in an interest period is calculated by applying the daily rate of interest to the principal borrowed, and the payment due at the end of the period is the sum of those amounts. The second convention is compounded interest. This approach recognizes that the issuer of floating rate notes does not pay back interest owed on a daily basis, and it therefore keeps track of the accumulated interest owed but not yet paid. The additional amount of interest owed each day is calculated by applying the daily rate of interest both to the principal borrowed and the accumulated unpaid interest. The ARC has indicated that the economic difference between these two calculation methods should be expected to be quite small at lower interest rates and over short periods of time, and has published a user's guide to SOFR that includes formulas and worked examples for each type of calculation. When SOFR notes were first issued, issuers generally tended to use a simple interest convention, but the compounded interest convention has gained traction in the marketplace over the last several months, with a number of companies issuing preferred stock or notes using the compounded interest convention. Based on market commentary, some issuers, investors, and other market participants prefer to use simple interest because their IT systems are already set up to accommodate this type of calculation. On the other hand, the compounded interest convention more accurately reflects the time value of money, which becomes more important as interest rates rise. In addition, the ISDA definition of SOFR uses the compounded interest convention, meaning that this convention may allow for more accurate hedging. As I mentioned before, calculating the average SOFR rate in arrears means that there's very little time to calculate interest before payment is due. There have been a number of conventions designed to allow for longer notice of payment within the in arrears calculation framework. The most common of these interest calculation mechanics are a payment delay, or a lockout, or a look back. The slide on your screen now provides a summary of the way that these three conventions work. The first line of the table, plain in arrears, demonstrates the problem. SOFR the overnight SOFR rate for any given day is not published until the next day. This means that unless additional terms of the notes are added, the rate for the final day in the interest period will not become available until the final interest period. The red lines track the relationship between the SOFR rate and the publication date for SOFR, demonstrating the problem. With a payment delay convention, which is the second line in the table, payment for a particular interest period is simply delayed some number of days until after the end of the interest period. Often, we've seen 2 days used in the market fairly commonly. This allows the SOFR rates used in the calculation to reflect exactly the SOFR rates during the interest period, and it gives issuers plenty of time to calculate interest. On the other hand, investors have to wait to receive their payments. The third line of the table demonstrates how a lockout convention is used. A lockout convention provides that a certain number of days before the end of the interest period, the overnight rate for this specified date will apply for the remaining days in the interest period. This provides issuers plenty of time to calculate interest and allows them to pay interest on the final day of the interest period. However, it has the disadvantage of meaning that the overnight SOFR rates used in calculating the interest rate for that interest period are not the exact same as the rates that actually emerge in the market during that interest period. The final convention is a look-back convention. Under the look-back convention, the overnight SOFR rates used to calculate average SOFR are lagged several days throughout the interest period. This means that more actual overnight SOFR rates are used to calculate interest for each interest period. However, it still doesn't align the overnight rates exactly with the days included in each interest period. Finally, I'm going to touch briefly on some recent headlines around SOFR. SOFR has landed in recent headlines as a result of volatility in the overnight rate. Market participants have noted that overnight SOFR tends to increase, sometimes sharply, at month-end or quarter-end. Most recently, on September 17th, a dramatic rate increase in overnight repo markets, the markets underlying the Federal Reserve Bank of New York's calculation of SOFR, caused overnight SOFR to spike to 5.25%, setting a record. It has since returned to more normal levels. The Wall Street Journal reported that this volatility has led a number of market participants to express doubts about SOFR's suitability as a replacement for LIBOR. The ARC responded to these criticisms by pointing out that average SOFR rates have remained quite smooth, even taking into account recent volatility, while acknowledging that SOFR and other overnight repo rates are inherently more volatile than rates such as SOFR that are published on a daily basis. The charts on this last slide that you see demonstrate the ARC's point that although overnight SOFR can tend to be volatile, the averaged rates based on overnight SOFR do tend to be smoother over time. So to summarize, I would say that the market for LIBOR transition provisions and SOFR provisions continues to develop day to day. Recent events continue to influence the way market participants think about SOFR as a replacement rate for LIBOR, and we will continue to monitor these developments as they arise. Thank you very much.